Netflix stock just tanked 8% after its latest earnings, hitting a 4-year valuation low. But while Wall Street is panicking, I see a massive buying opportunity. Today, I'm breaking down the actual numbers to show you why the market has this completely wrong, and why this might be the best entry point in years. There are 3 main reasons why investors are selling Netflix stock right now. The first major concern is increased competition. The bears are arguing that consumers are spending more time watching short-form content on platforms like Facebook, Instagram, and YouTube. YouTube is also leading in US monthly TV viewing with over 13.4%, way ahead of Netflix at 7.8%. Netflix's share of TV viewing has declined every single month since it hit 9% back in December 2025. The second major concern is slowing revenue growth. If we take a look at this chart, you will see Netflix's revenue growth rate for the quarter declining to just 13.4%. And the third main concern is that Netflix are actually forecasting even slower quarterly revenue growth at 12%, which was below what investors were expecting. But if we take a closer look at what's happening inside the business, Netflix's moat is actually getting stronger. Management say they see significant long-term runway to grow the business, with under 45% household penetration of 800 million addressable households, and roughly 7% of addressable revenue, which they estimate to be a $670 billion market, and about 5% of global TV viewing share. So despite the negative sentiment, Netflix's business clearly has many decades of growth ahead. And in terms of scale, Netflix is in a league of their own in the streaming business. Netflix sees its 330 million subscription households as a core strategic asset, enabling massive global amortization of content costs and better ROI. This is one of Netflix's main competitive advantages. They're able to spread the cost of content across a much larger subscriber base than other streaming platforms like Disney+. And this creates a flywheel effect where Netflix spends more on content, which increases engagement. Engagement is how Netflix measures subscriber satisfaction. High engagement reduces churn, which is the rate at which subscribers cancel their Netflix membership. High engagement and low churn signal a value surplus, giving Netflix the ability to increase prices without losing subscribers. Netflix can then use that extra revenue to reinvest into more content for the entire cycle to repeat again. This flywheel is what allows Netflix to continually compound and increase their lead as the #1 paid-only streaming service. The other major advantage that scale creates for Netflix is the ability to monetize in other areas. The most exciting opportunity that I see for the business to re-accelerate revenue growth is their advertising business, which is expected to double year over year to $3 billion in revenue. With all the negative sentiment around the stock, hardly anyone is even talking about this. If we look at YouTube, who are the industry leader, they make over $40 billion every year from advertising alone. Netflix's total revenue, which included just $1.5 billion from advertising in 2025, reached $45 billion. So YouTube's ad business is basically the same size as Netflix's entire subscription business. But the difference is that Netflix already pays for content production, so its advertising revenue isn't divided up between the platform and creators like it is on YouTube. And YouTube's ad revenue is still growing at a respectable 12%, while Netflix's ad revenue is doubling year over year. I don't see any reason why Netflix's advertising business can't reach a similar scale to YouTube over the next 10 years. Now I'm going to show you why Netflix's fundamentals continue to show promise long term. If we take a look at Netflix's free cash flow, you can see how as the company scaled, their free cash flow completely flipped. Netflix produced $11 billion in free cash flow over the last 12 months alone. Like we discussed, this free cash flow can be used to spend more on content to accelerate that growth flywheel, or it can be reinvested to scale the advertising business. When you produce this much free cash flow on a consistent basis, the possibilities are almost endless. But to take advantage of the huge decline in their stock price, Netflix is using that free cash flow to ramp up their share buybacks. Last quarter, they bought back nearly $5 billion worth of their own shares, which equates to roughly 2% of the entire company. And then if we take a look at Netflix's operating margin, you'll see how scale has changed the company's profitability. 10 years ago, the company had 83 million paid subscribers with less than a 5% operating margin. Today, Netflix has over 325 million paid subscribers, and their operating margin consistently hits above 30% and is still growing. This shows that Netflix has huge operating leverage, meaning as the company grows in size, it also gets more profitable because revenue grows faster than expenses. This chart illustrates Netflix's operating leverage perfectly. You can see their revenue, represented by the dark red bars, outpacing their expenses, therefore lifting the red line, which represents their operating margin. And we can apply this same logic to Netflix's content budget. A lot of investors are worried about Netflix increasing its content budget, but this chart shows you how Netflix's revenue in dark red is outpacing the growth of its content costs, represented by the light red bars as cost of revenue. If we look at Netflix's gross margin, this is yet more evidence of their ability to grow revenue faster than the cost of that revenue, increasing from 33% 10 years ago to over 50% today. But what about Netflix's valuation? Their free cash flow yield is sitting at just under 4%. So on the surface, you wouldn't say that the stock looks cheap. But if we dig a little deeper, we can see that from a historical perspective, Netflix is trading at its highest free cash flow yield since October 2023. If you would have bought Netflix stock back in October 2023 and held until today, you'd be up around 90% on your investment. So clearly there's more to this story that just looking at the free cash flow yield in isolation won't tell you. Then if we look at Netflix's PE ratio, you'll see it currently trades at 20 times forward earnings. That's about the same as the forward PE ratio of the S&P 500 index. But Netflix is certainly a better business than the average of the S&P 500, again suggesting that Netflix stock is undervalued. And then from a historical perspective, Netflix currently trades at its lowest PE ratio since the sell-off back in 2022. If you'd have bought Netflix stock back then, your investment would now be up by roughly 150%. So with that being said, I'm going to show you my base, bear and bull case assumptions for Netflix stock over the next 5 years. In my base case, I'm assuming free cash flow per share growth of 20% and a 3.5% free cash flow yield. In this scenario, Netflix stock would increase from $70 to $200 per share in 5 years, producing a 23% annual return. Way better returns than the index. But in my bear case, I'm assuming 15% free cash flow per share growth and a 4% free cash flow yield. In this scenario, Netflix stock would increase from $70 to $140 per share, generating a 15% annual return. So even my bear case is suggesting that Netflix stock is a pretty good buy right now. But what if we're super bullish on Netflix stock? In my bull case, I'm assuming 25% free cash flow per share growth and a 3% free cash flow yield. In this scenario, Netflix stock would increase from $70 to over $280 per share in 2031. That's a 33% annual return, or 4x upside from today's price, which is why I believe so strongly that Netflix stock is a great opportunity for investors. And I've got real skin in the game, with Netflix currently making up 12.5% of my own portfolio. I initially invested 15% of the portfolio into Netflix stock, but since then, the stock kept dropping, and as you can see, I'm down almost $300 on my position. But the price of Netflix stock doesn't affect my sentiment on the overall business. Netflix keeps compounding its fundamentals at an attractive rate and is still, by quite a distance, the strongest streaming business in the world.